Well, good Wednesday morning. Welcome to Connect, the California MBA's weekly podcast featuring interviews with movers and shakers in the mortgage industry. It's the end of the month, so what we're doing at the end of the month now this year is we're doing little mini panels based on the topic that we've covered during that month. So I'm excited to welcome in a three-person panel of some of the top rising stars in the commercial real estate finance industry. So we'll get to that conversation here in just a minute. But before we do, let's thank our sponsors over at Accelerate. So if you're looking to close more loans in 2021, and that should be you, that should be everyone, you should definitely check out Accelerate's new platform and experience Accelerate's award-winning customer engagement efforts and their products that feature lead management, CRM, call routing, sales enablement, marketing automation, borrower engagement, and data intelligence through innovative use of multi-channel marketing, which includes text, social media, email, direct mail, phone, ringless voicemail, retargeting, and very much more. So if you've got any questions about how to find out more about Accelerate, definitely make sure you're following Josh Friend on LinkedIn. He's got a lot of good content they put out on LinkedIn. And if you want to schedule your personal demo, make sure to go to accelerate.com. You can do that there. All right, before we jump into the conversation, I want to toss it over to our CEO, Susan Milazzo, for this week's update. Susan.
Thanks, Dustin. Hi, this is Susan with the California MBA, here to give you some exciting news. As you might have noticed from our conference marketing for 2021, we intend to hold our Western States CREF conference in person this year, September 8th, 9th, and 10th. We have received recently information from the Las Vegas Convention and Visitors Bureau that the state of Nevada, their governor has announced that if their COVID rates continue to trend positively, that as of May 1st, the state's restrictions will be lifted and turn control back over to the county. So this is really positive development for our ability to hold this conference in person in early September. Of course, we'll have all of the health and safety protocols will still be in place at the ARIA, and we're looking forward to a successful but still very safe and healthy conference to welcome you in this year. If you're interested in information on how to participate in the Western States CREF Conference, you can visit our website. That's it for this week. Back to you, Dustin.
All right, thanks, Susan. Lot of good news there. We're planning very hard at this moment for our annual Western States CREF Conference, and after last year's virtual event, we're definitely looking forward to getting back in person. So that's definitely good news from our friends in Las Vegas and the Visitors Bureau there. So let's jump into the conversation. I want to welcome in three of the rising stars in commercial real estate finance. Today we've got Sarah Bernhisel, who's Vice President with Slatt Capital up in Burlingame. We also have Pasha Johnson, one of the principals at Pacific Southwest Realty Services in San Diego. And then in the LA offices of Gantry, we have Amit, Tyagi, one of the senior directors there. So welcome, everyone.
Thank you.
All right, well, let's jump into the questions here. We'll start with you, Amit. Why don't you tell us a little bit about your background, how you got in the industry, and then how you wound up at Gantry?
Sure, yeah. So I'm born and raised in Los Angeles. I grew up in West LA, kind of in the Mar Vista neighborhood. I went to high school in El Segundo, played basketball there, and then I went to UCLA. Studied economics at UCLA, and when I graduated, kind of in the depths of the Great Recession, not knowing where I was going to end up, I took a job in wealth management, and I ended up hating it. I had done a couple internships with Colliers and had some experience in the commercial real estate world while I was in school, and also kind of grew up around real estate. My dad was a civil engineer for 30 years, developed a few apartment buildings here in LA, and so I've always been around real estate my entire life. Growing up, it was more like, hey, go fix the sink in 203, but you know, kind of have progressed since then, and heard about the opening in our LA office at the time when I stopped the wealth management work, and a fraternity brother of mine in our Seattle office at the time told me about the opening. That was 10 years ago now. Put my resume on a desk, and it's kind of been the perfect niche where I have this quantitative side that is satisfied with our roles here, and then also there's a relationship and personal aspect of the business that I love too. But that's kind of been my route. I was an analyst and an associate in our firm when I started off, and made the jump to production, and have been doing that for the past few years.
Yeah, well, it sounds like you tried to escape the real estate life, and just it pulled you back in, right?
maybe I tried to avoid doing what my dad did, and realized maybe that was the calling the entire time.
You can't avoid genetics, apparently. So Sarah, how about you? How'd you wind up at where you're at there at Slatt Capital?
Yeah, so as you mentioned, I'm a debt originator at Slatt in the LA office. I've been in the industry for about 9 years and collectively with Slatt for about 5. I also graduated in around 2008, so not a great time to be entering the job market, but I was lucky in that I got a job actually with the Marsh & McLennan companies in New York City. But in 2012, Slatt actually took a bit of a chance on me. I had some friends that were in the real estate industry in Southern California and were starting to do well. So I moved out to LA in 2012 and started as an analyst at Slatt. And then in 2015, I actually moved up to San Francisco to join JLL's Debt and Structured Finance Group. And then in 2019, Dan Friedeberg, our CEO, recruited me back to team with him on the production side. And actually, just last month, I relocated from San Francisco back to LA. So it's been great to be back in LA and the Southern California. And also, I don't know if you guys are familiar with Slatt Capital, but just a quick background, it's formerly Barry Slatt Mortgage Company. We're a boutique mortgage banking firm. We're headquartered in the Bay Area, but we have offices, 7 offices throughout California. We have a servicing portfolio of about $4.3 billion, and we place and service loans nationally.
Yeah, well, we're very familiar. I mean, Barry Slatt was one of the originals here at the California MBA for sure, and one of the founders actually of the Western States CREP conference that is definitely a nationally recognized real estate finance event. So yeah, absolutely. Pasha, how about you? How did you, what brought you into the industry and to PSRS there?
Yeah, definitely, and thanks for having us, Dustin. My experience was similar to Amit's in a way. I'm a native San Diegan. Grew up in San Diego, went to San Diego State. Never left as I'm looking out the window and it's 75 and sunny and realizing I'm probably never going to leave. While at San Diego State, I was turned on to real estate. Like Amit, I had some family in the business. Joined the Real Estate Society, and as a sophomore through senior year, kind of never-ending saga of coffee interviews with gentlemen that had already found their path in the industry, and finally found a place at a regional brokerage here in San Diego. And that's really where I cut my teeth. At some point, they brought on some gentlemen from Wells Fargo to build out a debt brokerage team, which is where I discovered my passion, if you will, and eventually made the hop over to PSRS, or Pacific Southwest Realty Services, where started as an analyst, eventually made the jump into production, and actually just the first of this year bought in as a partner of the firm.
All right, well, hey, congratulations! Great company, and we certainly know Dan Phelan and Michael Tanner there over at PSRS very well. You guys have been great members for a long time. So let's fast forward to today's marketplace. We've certainly spent the last few weeks chatting with some folks in the industry and getting their perspective on the industry. But as 3 sort of rising stars in the industry, I'm interested in your perspective as well. So Sarah, let's start with you. What's the current state of the market from your perspective, and what's your outlook for the remainder of this year?
Yeah, so overall, the real estate market, I think, is still in a state of flux. We're continuing to see contraction in retail and office, but industrial is expanding tremendously, while I think multifamily, for the most part, is holding strong. I think this trend is going to continue through 2021 until the vaccine is fully rolled out and investors become more bullish on what the post-COVID environment is going to look like when there's herd immunity. Also, I think the Fed has continued to calm the market by taking a patient approach on interest rate hikes, and I think you're also going to see that approach continue as the economy recovers from COVID in 2021. And I think you're going to see interest rates remain low for the next few years. Just speaking to the 10-year Treasury, in the last 5 days, we've seen a bump in the 10-year by 14 bips. In the last month, we've seen an increase by 26 bips, but compared to this time last year, it's down 13 bips, and compared to 3 years ago, we're down 150 bips.
Yeah, there's a lot of opportunity for growth there for sure in the year, and I think you're right about the Fed being patient with interest rates. I think that's definitely a good thing for everyone. Pasha, what's your take?
Yeah, to me, it kind of feels like we're stuck in purgatory, and we have been for a while. The tide hasn't really come out completely. There's certainly been some winners and some losers. And as Sarah said, office, retail, hospitality, some of those have become a little more tricky. But in the same way, there's definitely been a few asset classes that have benefited. I know here in San Diego, there's been a huge shift towards life science. Pretty much all of our Class A office brokers have already changed their name tags to Class A life science brokers. And shifts like that kind of come with their own, host of challenges that lenders might not be used to. So for life science, for example, the higher TI and LC costs and prices create for a loan per square foot that might have some of these guys, have their eyes popping. And unless they're from the Bay Area or from Boston, they might not fully understand the depth of the demand of these markets. So we spend a lot of time kind of showing them the market data and getting them comfortable with those types of asset classes. As far as outlook, I'm an optimist. I know that's kind of ironic to work in the debt space and be an optimist, but I think that as things continue to lighten up, and there's been so much intervention, at least to fix the short term, even if it comes at the cost of the midterm or long term, that I think we'll see lenders start to get more bullish and start to foray back into some of the asset classes right now they're not touching.
Well, do you think specifically on the life sciences, this came up in last week's podcast, and I asked the same question. I'm curious your take on it. Do you think that's a long-term trend, or do you think at some point we're going to have a little overheating in that life sciences market once the vaccine's out there, once we kind of get back to something something close to normal in the marketplace?
It probably is a little bit market specific, but for us here in San Diego, and I think it's the case in several markets, this is just an acceleration of a trend that's already been happening. There are definitely a lot of the smaller firms that are making their money from coronavirus-related products, but there is a very deep and diversified pool of life science tenants. And what we're seeing right now, down here anyways, is that it's kind of a snowball effect, because a lot of these tenants or companies assist other companies in the same space. So if you have large companies like Illumina or other companies that are similar in size, and you have these smaller companies essentially moving in and providing them goods or services and kind of expanding that way. So yeah, I think there might be a small pullback, but in general, I think we'll continue to see a move in that direction.
Still pretty steady. Okay. Amit, what's your take on the state of the market and going forward the rest of this year and beyond?
Yeah, it's hard not to agree with both Sarah and Pasha on the comments that were made. I think just kind of following up on what Pasha was saying, I think it is interesting right now, and actually Sarah's point too, where multifamily and industrial seem like hot asset classes for, debt and equity. All investor types at this point really are focused there. As we kind of see what the changes may or may not be for the retail and office sectors, it is putting additional light on kind of some of those other categories, like Pasha was saying, life sciences. We're seeing medical office have a lot of attention right now, and we're super busy with the self-storage space right now as far as an asset class goes. As far as the lending world goes, I think we're definitely very thought out from what the freeze was, call it middle of last year. I think a lot of lenders were on the sidelines looking inward to their portfolios to see where risks may or may not be at the time, and have, they've since adjusted their portfolios, made some accommodations on loans that needed some help, and are now again back on the playing field putting loans out. So I think the first few folks back in the lending space were the balance sheet lenders. We do a lot with the life insurance companies here at Gantry, and so the life insurance company market has been healthy for, it feels like 6-7 months now. and we're starting to see CMBS pick back up, which is great. So I think it'll help with liquidity from the debt side. As far as some of those questionable or more questionable asset classes go, they'll play probably more on the retail and office space than a balance sheet lender probably would at this point in time. But I think generally speaking, the capital markets seem like they're getting healthier and healthier every day. As long as the vaccine rollout and no other strain pops up that pushes us back into pandemic mode, I think we'll be back. And I think I agree with Pasha. I'm optimistic for what 2021 has to bring. I think there's been a lot of patient capital on the sidelines, which I think is good. And I think we'll see that rebound really keep the market healthy right now.
That's good. I love hearing three optimists here, three good positive takes on the market. That's good. All right, Pasha, let's switch to you here. Let's switch gears. And I've got a question about the administration and its potential impact on the industry. Obviously, we're only a few weeks into the new Biden administration, but from your perspective out there in San Diego, what are some of the things you're keeping an eye on as far as potential impacts on the market?
Sure. Yeah, there's a couple of metrics in particular that I'm keeping my eye on. First being the extension of the foreclosure and eviction moratoriums until June of this year. This has already impacted the way that we underwrite deals. Collections reports have become a pretty critical metric that we look out for, and I got to imagine that investors on a go-forward basis will be looking at not just asset class but markets in terms of what they can collect. Another big thing that I'm looking at is obviously Biden's pushing for a $1.9 trillion stimulus plan right now. That would bring total government stimulus relief up to $6 trillion in the last 12 months. It's a pretty staggering number. And that type of intervention obviously in my opinion anyway, pushes us towards a more inflationary environment. And if that happens, I think it's going to have some pretty noticeable impacts on real estate. Actually, in my opinion, I think it's a great time to be a borrower as we enter an inflationary environment. Generally, during inflation, wealth transfers from lenders to borrowers as they lock in a fixed rate and pay back with cheaper dollars. Obviously, they're going to benefit from the asset appreciation as well. And another, maybe side effect that we might see is extended low rate environments might also increase or show a widening in the wealth gap. Those that have assets or are paid commissions based off of asset values will probably benefit, and those that are paid a fixed salary but might not. So some of those things that we're keeping an eye out for.
Absolutely. Amit, what about you? What's keeping you up at night thinking about potential impacts from Washington?
I think the key one is what Pasha hit on is the stimulus. So I think the stimulus will have effects on inflation. I think there also may be tax policy coming in the future that could affect how wealth is transferred from generation to generation. So there could be impacts there as well. Yet to be seen kind of what that may entail, but we're already seeing some clients try to get ahead of that. Like Pasha said, rates are still low and it's still a good time to be a borrower. And we're seeing a lot of people change their strategies a little bit. I mean, we have a client who's historically borrowed on a 10-year fixed rate basis who is now looking forward, and we just signed up a 25-year fixed rate loan, still sub 3%. So, an incredible interest rate that they can carry forward into the future. And if inflation comes, it's all the more beneficial to have something like that locked up now. They're also seeing that as a potential estate planning tool later, giving them at least flexibility for a portion of their portfolio as they can amortize that debt closer to zero at what are still historically low interest rates. So, the stimulus is out there, inflation's coming. It sounds like the Fed has taken a stance that they're going to use their, the tools in their toolbox to try to manage the inflation as best they can. And so, while I think rates continue to trickle up for some time, I still think we stay in this historically low interest rate environment for at least the next couple of years as we try to manage that inflation. Who knows how hard it hits, and if we run out of room to dial it up or dial it down from monetary policy perspective. But those are some of the things we're seeing out there now.
Yeah, well, it's funny you mentioned the low interest rates for the next couple of years. I think that, once you get inch closer and closer to 2024, it's going to be kind of hard for anyone to imagine interest rates going up at that point. So I think you've got a good point on it. on interest rates being low for quite some time here. Sarah, how about you? What's your thoughts on potential impacts from Washington?
Yeah, I mean, I think the outlook for Biden's impact on the market overall is optimistic. I mean, there was so much instability in the last administration that I don't think you're going to see moving forward with the new administration. I think the larger, federal stimulus package is going to help boost real estate demand in the near term. And I think more aid to state and local governments could reduce pressure to raise taxes on real estate. One of the bigger concerns, I think, is the potential elimination of the 1031 exchange program. If 1031 exchange is eliminated, that would heavily disincentivize investment in the real estate market. And I think the impact it would have on just the economy, the neighborhood or neighborhoods, and just real estate in general would be pretty awful.
Yeah, absolutely. So Sarah, let's stay with you for this next question here. We're going to switch gears a bit here. But tell us, what do you think is a potential maybe hidden gem in the market right now? Maybe a silver lining or a great investment opportunity for the right borrower. We hear a lot these days, and if you just read the trade presses, there's a lot of negative thoughts about retail and office and hospitality. So what do you see any potential gems out there that are untapped resources right now?
Yeah, I mean, we've talked a little bit about how, the retail sector, continues to be challenging for investors and lenders for a number of reasons. So I think, as we've seen in the past, we're going to continue to see a lot of opportunity in retail big box regional retail centers, shopping malls, converting to either industrial warehouse space, distribution centers, or multifamily. I also think that there's a lot of opportunity in the hospitality sector right now. I mean, I think we've got investors waiting on the sidelines, just ready to pounce on properties that are distressed. And I think it's a timing game, and it's really hard to say, when leisure travel is going to completely bounce back. But, I'm certainly ready to, go vacation in Europe when it's safe to do so. So I think that, we're going to see a major comeback in this asset class in the, nearest future.
Yeah, that makes sense. I think everyone listening along right now is nodding that yes, I'm ready to take a vacation and go somewhere too. Stay in a hotel at some point as soon as we can.
Yeah.
Pasha, how about you? What any hidden gems or untapped resources out there that you see in the market?
Yeah, I kind of like Sarah's contrarian answer in that retail and office, I don't think those asset classes are going away. I think there's definitely going to be a change in the way that we use them. But some of the more stale asset classes in good locations poses a really good investment opportunity for the right sponsor that can figure out how to position it accordingly. I'm also a bit bullish on single-family residential rentals. I think that as we see kind of a trend away from the cities into suburbia with backyards, and maybe some of these families aren't quite ready to buy their first home, there's going to be a pretty notable demand for rentals in the single-family residential space.
Makes sense. Yeah.
In terms of,
go ahead, Pasha. I'm sorry.
Yeah, in terms of untapped opportunities, I think it's great working with someone like us or Mayor Sarah in finding the right financing for some of these challenging products. I know a lot of lenders are just broad brushing all asset classes together, but it's certainly not the case for all of them. And making sure that your capital stack looks competitive going into some of these deals can really give you quite the leg up.
Makes sense to talk to a pro. Totally agree. Amit, how about you? What do you see out there that maybe someone else doesn't see?
I think if I could actually point to a specific hidden gem, I might be sitting in the wrong seat in the industry. But I do think that generally speaking, the silver lining is that friction breeds opportunity. And so I think COVID has created plenty of friction in the marketplace. And I think, the stimulus and things that are kind of helping to prop up what could be a really otherwise ugly situation from an economic standpoint will eventually, go away and will dry up, whether that's 2 or 3 years from now. But I think the teeth of the recession might actually show once those things start falling off a little bit. I think there's something like 15 million Americans who are behind on rent. At some point that either has to be paid back or they have to find a way to get current, or there could be a lot of evictions, a lot of personal bankruptcies. But that being said, I think there is great opportunity. Obviously, I think retail and hospitality, there could be opportunity to find investments at pennies on the dollar. I think note purchases could be a good place to look. If there's a distressed asset, it could be a good time to step into those roles for a borrower and really have their chance to get something with an incredible basis that fits their wheelhouse. I think and I think as the time goes, as the tide kind of rolls back out, we'll see who's really equipped and standing on 2 feet or not right now too. I think borrowers who have some liquidity, who have a corporate infrastructure with a team around them, who can pick up a distressed asset, a construction project that falls to the wayside or whatever it is, can be in a position to really benefit from the opportunities that come up here. And like Pasha said, these are challenging transactions, both for a borrower and an investor, but also on the debt side. You shouldn't try to put a square peg into a round hole. It is worth speaking to an advisor to help really craft a vehicle that fits the business plan well, especially as these business plans get trickier. There could be some, accretive value in your returns with the right debt vehicle as well.
Absolutely. Absolutely. And I think all of you, if you're interested in finding out some more, obviously you got three great professionals right here, and all their contact information is in the description here below to contact them if you're interested. Pasha, let's go to you for this next question. We had fun with it. We asked this last month during our mini panel, and really had a lot of fun with it. So I'm curious how it goes on this side. But Pasha, tell us your best or your worst sales story. Maybe a great win that you had that was that really fires you up, or just a major crash and burn that you learned a lot from.
Yeah, I think that probably all of us here, came out of this experience with a little bit thicker skin. I know I certainly did. One deal in particular that I think is kind of worth sharing, or at least interesting. We had a sponsor here in San Diego he's an architect developer, build a pretty unique product. It mirrored multifamily in a lot of ways, but he was running the entire thing through Airbnb. So essentially a hospitality use apartment complex. The demand there made sense. There's plenty of comps to point to. And we were working on the takeout of his construction loan under application. Things are moving along smoothly. I think he was at 80-85% occupancy. And then obviously when the pandemic started intensifying, his occupancy dropped, I think, from 85% down to 5% in the matter of a week and a half. So ran into some issues there. Timing, obviously important coming out of construction loan. The lender that we worked with was really understanding and actually, I thought, very creative. Decided to bake in an interest reserve that would be drawn down much like a construction loan, not hanging over your head to make payments outside of the reserve, and made an agreement with the sponsor that within 12 months, if he's not back up to a certain debt coverage level, he would agree to convert the property to multifamily use. So that worked for everyone. Obviously the lender knew that they would be paid their interest throughout the next year, and the borrower had time to readjust and obviously hit the metrics like he needed to, all the while having a backup plan there for him. And I'm happy to say that today he's back to where he needs to be. I think he only has a brighter outlook going forward. So that was a good story, pandemic story.
Yeah, that's the proverbial win-win there. Amit, how about you? You give us your favorite sales story.
Yeah, so I'll go back to kind of well before the pandemic when I first jumped into the production side of the business. Your day one in production can be a little bit strange. You're kind of sitting there at your desk, and all of a sudden you got to figure out what you're going to do next. And so, spent a lot of time trying to make some cold calls and then going to conferences and things like that. You start planting these early seeds that gosh, the fruits of your early labor can be minimal as you're trying to build any sort of a business. So, there was, it's hard to keep the hope up and the momentum each day. And as you're, finally there's a breakthrough, and mine happened to be, I was sitting at a conference. I'd gone to kind of many conferences and was marketing in that arena, and was sitting next to someone at lunch who we got to chit chatting, and he learned a little bit about what I do, and he said, "Hey, you should go talk to that guy over there," and pointed to someone a couple tables over. I went over, said hello, stayed in touch with him for about a year, went in and interviewed, and told him about our platform and what we were able to do. And fast forward from the time I met him to maybe call it 15 months later, closed a $41 million loan. And as a young producer, it was very much a big win. But I think looking back on it, more than the dollars and cents of it all, it was the confidence and morale boost of knowing that I could do this thing, right? So it was kind of an early pivot in my career or not really pivot, just I guess breakthrough in my career at that point that gave me confidence, that kind of put some wind at my sails to keep up the work, keep planting those seeds that later will bear some fruit. And so it was a breakthrough in that at that time.
Well, I think you make a good point there too, that it isn't just a one giant victory as much as it is a series of smaller victories that get you to that point where you break through like there. So that's a great story. Thank you.
It's the cliche, or maybe it's not a cliche, but you hear the line that it took me X amount of years to become an overnight success, and in that moment it felt like it. So it was very much in a similar vein to what you're saying, Dustin.
Absolutely. Sarah, how about you? What's your favorite sales story?
Yeah, so mine's a recent one and has to do with COVID. So in July last year, we closed on a refinance of an assisted living facility in Redwood City. We first got under app with the lender the first week in March. And then mid-April, we learned about the devastating number of deaths at the facility due to COVID. And as you can imagine, this was extremely difficult for the borrower. They had owned and managed this facility for many years. And at first we didn't know how the lender was going to react. We weren't sure if they were just going to pull out altogether. They were going to change the terms. This was mid-April. Everyone was kind of freaking out right at that time. And just long story short, our team worked very diligently with the lender. This is a lender that we've had a very long relationship with. And they ultimately closed at the terms that were originally apped. Through the process, we had a lot of difficult conversations, but at the end of the day, the borrower got a great deal. It was a cash out refi on an owner user property, and the short-term economics of the deal changed, but the lender held firm. And she was just, she got a 320 rate fixed for 7 years. So it was just one of those situations that, under such just sad, unfortunate, unforeseen circumstances, I was just, I felt like the borrower was taken care of, and I was really proud of the work that my team did, and proud of the lender as well.
Yeah, that's really inspirational. Yeah, I mean, it's certainly one of those times. If you're saying it was in April, I mean, that absolutely could have, sounds like, gone south, and with all the panic in the market at the time, I mean, that could have gone any one of a number of bad directions. So that's great that it turned out well for everyone involved.
Yeah.
All right, well, let's go to our next question here. Amit, we're going to start with you, and we're going to do sort of a lightning round here with this question. So real quick, tell me what you're more concerned about long term. Is it retail or office?
I'm more concerned about office in the long term.
Sarah, how about you?
I'm more concerned about retail.
Retail, okay. And Pasha?
Yeah, I'm not as concerned about either.
There's the contrarian view right there. The positive contrarian. Okay, well then, what would you be more concerned about long term, Pasha? I'm curious.
I think that's a good question. No, I think that retail and office, as things start to get back to normal, especially for office, people say that you're not going to come back into the office, but as soon as your competitor does and starts to win business that you aren't, I think that's going to start changing. And retail, I think it's going to be more of a conversion from some of the uses that we're already seeing we're struggling to more entertainment or service-oriented uses. So I guess the challenge there really is how you manage that, move from one traditional retailer office use to the retailer office of the future.
Yeah. Well, I guess here's the catch, I can't get Pasha, down there in San Diego. I can't get him to, our optimist. I can't get him to give us a negative outlook on anything right now. That's great. Okay, so we got a couple more questions here, and I'm curious. Again, we've got three, up and coming young stars in the industry, and I'm curious what your advice would be for younger folks that are just now coming into the space. I mean, I think all three of you have mentioned that you came into the industry sort of in that 2008 to 2010 period, when it was not exactly the best time to get into the real estate finance industry. But what advice would you have for younger folks coming into the industry, and specifically, what can the industry do to better encourage a younger, more diverse workforce? Sarah, let's start with you.
Yeah, so I think it's an absolute advantage being a younger person in the industry. Speaking for myself, when I first joined, I had very high energy and no intensive family commitments, which opened a big window for productivity. And I think Amit touched on this a little bit. I mean, with his story, it takes true grit and determination to succeed in this industry. So having the time and energy when you're first getting started I think is very important. Regarding diversity, I think being a champion of diversity doesn't end with hiring and onboarding new and diverse team members. I think a commitment to diversity is also a commitment to advocacy, support, professional growth, and sponsorship. There's a diversity advocate named Verna Myers. She's written a number of best-selling books related to this topic, and she has a quote that says, "Diversity is being invited to the party. Inclusion is being asked to dance." Initiatives to recruit and hire diverse people are definitely an important first step, but it's really inclusive environments that drive successful outcomes, in my opinion.
Absolutely.
Yeah.
Pasha, how about you? What's your take on and your advice to younger folks in the industry?
Yeah, definitely. So for me, kind of my favorite part of this industry has always been the personal element. I love going out and shaking hands and grabbing lunches and interacting with sophisticated and brilliant people in the industry. It's been a little tough for the younger folk today, and I definitely feel for them that it's not easy to get in front of somebody face to face, and doing it over Zoom, you lose a lot of the personal element to it. I think as things start opening up, I would really challenge you to try to get in front of as many faces as you can, safely, of course. But I think that's crucial. I'm a big believer that in blurring the lines between life and work, not only are your work relationships more genuine, but I just honestly think that your life becomes more fun that way. In terms of diversity in the workplace, I think there's no doubt at all that our industry is way behind in that respect. And I think there's a huge opportunity to change that. So I'm really looking forward to seeing that happen over the next few years.
Absolutely. Amit, let's end with you on this question. What's your advice for younger folks coming in the industry? I mean, specifically, what's interesting to me is, people coming in the last couple of years, especially who don't have that book of business built up. They haven't gone through the number of conferences and face-to-faces that you were able to go through that was necessary for you to have your breakthrough. So what would you tell someone just coming into the industry now that's been doing stuff, as Pasha said, on Zoom for the last year? How can they build that book of business?
So I think the key realization is that you have a network. No matter how young you are, even if it's a college student who's looking to break into the industry, the alumni network at your school can be a powerful tool. So even as a young person in the industry, like Pasha was saying, it's a relationship-oriented people business at the end of the day. No matter how much you think you can do it on your own, these transactions always involve more than one party. You're going to have to interact with other people. And I think it's key to just know that you have relationships through your network that are there and they're out there. I think, so I'm involved with UCLA's real estate alumni group. I'm a board member there, and we interact with the undergraduates and help get them ready for potential careers in commercial real estate, and I encourage them to reach out to folks our age here. We're, all of us have been in the industry for rounding out now about 10 years, and I think it can be intimidating to pick up the phone and call someone who's maybe 60 or 70 years old, who's been in the industry for 40 years, but it's a little less intimidating when you're talking to someone who's a little closer to your age, who's been early starting their career in the industry not long ago, and just ask them for some thoughts and kind of start hearing about other people they know who you should talk to, even if it's outside your specific niche in real estate. It can never hurt talking to an architect or an engineer or anyone else who's out there. That's how you slowly start building a network and figuring out where you may be able to generate business for yourself at the right time there. So I think that's key, is just reach out to the network that you have. You may not know you have one, but it's there if you look. And then as far as encouraging a younger, more diverse workforce, I think it's crucial. I think if you look at our cities and I take a cross section of the population, it's younger, it's more diverse, and I think it's starting to trickle into real estate. A lot of the newer projects we're seeing out there they're cooler and they appeal to young people. You're seeing more murals and things in common spaces that attract a younger crowd, and these are great things. And I think corporations and developers who aren't putting a focus in having a workforce that relates to the city, they're going to be left behind at some point. The trends will move straight past them. I think as far as an industry to kind of help with the youth and diversity efforts is, I think employers now need to empower their younger employees and give them opportunities where they can take on more responsibility, encourage them to do things like the three of us here are doing. All our firms were very clearly supportive of our efforts on this conversation. And the more that we're in front of the public eye, I think it will, get the industry more used to youth and more used to diverse employees, especially in roles of responsibility and in roles where they're decision makers. And I think it helps further those efforts somewhat organically. So, empowering the youth to take on responsibility is crucial, I think.
That's a great point. Amit. Thank you. So last question, we've got time for just one more question. And Pasha, let's start with you on this one. So this is one of those issues, advocacy, that typically we ask, folks who've been in the industry longer. I mean, maybe they've had 20 years in the industry, and then maybe they get involved in advocacy efforts, whether it's with, the California MBA, the National MBA, NAIOP, or another advocacy group. But I'm always curious, folks that are younger in the industry, what would you tell someone else? Because I know like PSR has been a member of the California MBA for a long time, and very supportive of the California MBA, the NBA, and some other advocacy groups out there. So what would you tell someone younger in the industry that doesn't maybe see the value yet in the advocacy work that these organizations do?
Yeah, I mean, I really can't stress enough how crucial your involvement in these groups are. Like Amit, I sit on the real estate alumni board at San Diego State, sit on the board at ULI here in San Diego, involved in BAYOP, all those groups. And just like my counterparts said, this is a relationship business. Those groups are fantastic ways not only to get education, but to make connections that either will end up as clients or friends or both. So I really think it is of critical importance. It's been a little bit tough during the last year with all the virtual events, but as things begin to open up, if you're not at these events, I really think you are missing out. And I would challenge the younger guys to not just join the groups, but to sit on the board. Everybody's looking for somebody to volunteer. And when you're young, kind of Sarah brought up earlier, you look at the gray hairs and they have something over you, and that's experience, but you have something they don't, and that's youth and time. You have way more time than they do. So I would put it to work and get involved with the groups and, try to make an impact whatever town you're in.
Yeah, well, and from speaking at least for the California MBA, I can't imagine a group out there that's going to say no if you want to get plugged in and get involved. So absolutely great advice. Amit, how about you? What's your advice for younger folks in the industry that maybe don't see the value in joining and getting involved in these advocacy groups?
I think advocacy is critical. I mean, especially at this point in time, if we look at the political landscape in this country, you can't help but notice how extremely polarized it is. The left feels very far away from the right, and there doesn't feel like a lot of middle ground. Here in the commercial real estate industry, our incentives are aligned. I mean, whether you have political beliefs on one side or the other, as far as an industry goes, we need to be on the same page with a lot of issues. And in a polarized political landscape, as regimes change, as we just saw, policy changes are more dramatic when there's big polarization in the landscape. And so as those policy changes potentially have large impacts, they're going to potentially have large unintended consequences too. And that can really throw a wrinkle into any industry from a business and operational standpoint. And so I think groups like the CMBA and the MBA are crucial to helping us stay aligned and work through and smooth out any of the wrinkles that can come with policy changes, particularly in this environment. And it's real. I mean, I know that there was, I won't get too into the weeds on the actual issue, but there was an issue affecting lenders that affected how much they could lend, how many loans they can do on apartments in any particular year. And there was some obscurity behind that. And I know there was a deal I was working on, apartment project, that the lender really liked, and they weren't able to lend on it, but we were able to get some clarity. There was an actual resolution that came with the help of the CMBA and the MBA, and efforts by those in the industry, that the lender called and say, hey, you know what, we're all of a sudden allowed to do this deal. There was a very personal impact that had for me. And it makes it very clear that these groups are crucial to us being able to function properly during times of major change. And so I'm a big proponent of groups like this.
That's a great example. Great example. Thank you, Ed. And Sarah, let's conclude the conversation here with you. What's your advice to younger folks who maybe don't yet see the value in advocacy work?
Yeah, I completely agree with Pasha and Amit. I think it is so important to support organizations like the CMBA, the MBA, ULI, NAIOP, whichever. I'm on the board. You don't want to spread yourself too thin. That's important, I think. Pick two or three. But I'm on the board of the Bay Area Mortgage Association, and I just think always it's very important to stay connected as much as possible in this industry. But I think especially right now, just with the market being in flux and the uncertainty, these organizations, they provide a great platform for CRE professionals to gain and share knowledge. And I mean, knowledge is power at the end of the day, and you're really just doing yourself a disservice, you and your client, if you're not out there just staying connected.
Absolutely. Well, I mean, fantastic advice there, especially on the last question, and fantastic conversation. Thank you, Amit, Pasha, Sarah, thank you for the conversation. Great to see all of you at least over Zoom. Hopefully later this year at our Western States CREP conference or at another event this year, we'll be able to see each other in person. But again, thanks for joining us today on the podcast.
Thank you, Dustin.
Thank you very much.
Dustin.
Thanks.
All right. Well, and if you enjoyed the conversation, make sure and subscribe to us here on our YouTube channel. You can also find us on SoundCloud, Spotify, and Apple Podcasts. And we'll be back again on Monday with another episode of Connect. And we'll see you then.